You know this curve, the peak of overconfidence, the valley of despair. It hangs in offices, it's all over LinkedIn, and crypto Twitter, they love it. But here's the thing. In the study it supposedly comes from, it doesn't even appear. This curve is a meme, but the thinking error behind it is real, and it costs you the most in one single place, your portfolio. But the real study behind it does exist. 1999. Two psychologists, Justin Kruger and David Dunning. Ever since, we've called the pattern the Dunning-Kruger Effect. The short version. When you're bad at something, you're often missing the very knowledge you'd need to see that you're bad at it. And with money, this error gets supercharged. 3 good trades, and your head starts telling you a story. The story of talent. I'll show you what the research actually found. It's more uncomfortable than the meme. You can test yourself today. And at the end, you'll get a tool that's more honest than your gut. Let's look at the real study. Kruger and Dunning had students take tests. Logic, grammar, even humor. Then everyone guessed where they ranked compared to the others. The weakest quarter actually scored worse than 88 out of 100 people, and still rated themselves above average. 50 places between feeling and reality. In one logic test, this group thought they'd gotten about 5 out of 10 right. The real number was 0.3. But here's the part the meme leaves out. The worst performers did not think they were the best. Just slightly above average. And the best? They actually underrated themselves. They figured, surely everyone else can do this too. No peak of stupidity, no valley of despair. Instead, almost everyone thinks they're above average. And the person furthest off is the one who knows the least. Now to you and me, to the stock market. This is Ben. 2024. The market is climbing. Ben buys 3 tech stocks. All 3 go up. 3 green arrows turn into a theory. I understand the market. So Ben doubles down, this time for real. Then the market turns. Ben's portfolio down 40%. And researchers have rebuilt this exact pattern in the lab. Careful at first, then cocky after a few wins. David Dunning himself with his colleague Carmen Sanchez. They had people learn a brand new task, 60 rounds long. At the start, everyone was careful. But after about 10 rounds, confidence shot straight up, way past actual skill. The researchers call it the beginner's bubble. That's the real curve. And now the uncomfortable part. This bubble never fully pops. Confidence stays permanently ahead of skill. Maybe you're thinking, nice little lab game. Then look at real financial data. A huge US survey, more than 25,000 people. Financial knowledge, tested. Self-image, measured. For real knowledge, the rule is simple. The older the group, the more they know. Almost a straight line. But the self-image does something else. It jumps. Right between the youngest and the early 30s, steeply upward. And then, for a long time, almost nothing. The first paychecks, the first investments, the first wins, and right in the middle of it, the bubble grows. If you're somewhere between 25 and 40, you're sitting right in the zone with the biggest jump. And here's how big this crowd is. Today, about 62% of Americans own stock, directly in funds or in retirement accounts. And among adults under 30, it's now about 44%. A whole generation just got into the market, most of them brand new at it. Which means a lot of portfolios are right in the middle of the bubble phase. Maybe yours too. That's nothing to be ashamed of. But it's worth knowing before the next confidence high makes a decision for you. Time for the test. First, the feeling question. How good are you with money compared to everyone else watching this right now? Better than half. Better than 70%. Lock in your number. Ben already has his. 70, obviously. And now 3 questions. The 3 standard questions of financial research. Ben plays along. Question 1. You have $100 in a savings account. 2% interest a year. After 5 years, is it more than $102, exactly 102 or less? It's more. Interest earns interest. Question 2. Your account pays 1%. Inflation is running at 2%. After 1 year, can you afford more, the same, or less? Ben hesitates. The same? Afraid not. Less. Inflation eats more than the interest brings in. Question 3. True or false? A single stock usually gives you a safer return than a stock fund. Ben is absolutely sure. True. False. A fund spreads across many companies. A single stock rides on one. 3 for 3? Nice. Now, the honest number. In the US, fewer than 1 in 3 people get all 3 right. Just 28%. So Ben's in good company. And the most telling part is in the fine print. On that hardest question, single stock versus a fund, almost half of Americans simply said, "I don't know." Sounds like weakness. It isn't. The thinking error isn't the gap in knowledge. The thinking error is not seeing the gap. But does this self-image actually cost money? Yes, and it's measurable. A famous analysis looked at the accounts of more than 66,000 households over 6 years. The ones who traded the most, constantly buying and selling, earned about 11% a year. The market over the same period, almost 18%. The most active traders fell behind the market by around 6.5 percentage points, year after year. Now, this is an observation about the average, not advice for your portfolio, but it shows what an inflated self-image costs. So what drives all that trading? Real account data points to exactly one feeling, not even how sure people were about their guesses, but the belief that they're better than average. And the pros? In one experiment, they had to predict where stocks would go. They got 4 out of 10 right. A coin gets 5. They were confident anyway. Experience alone does not cure this error. Now, I have to be honest for a second, more honest than most videos on this topic. Researchers argue about the Dunning-Kruger Effect, to this day. The accusation, part of the famous pattern, comes from pure statistics. One research team poured random numbers into the same chart, and chance painted almost the same picture. So does that mean it's all nonsense? No. The largest pre-registered retest ran with more than 7,000 people. The pattern held. So the honest answer is, the pattern is real. The fight is about why and how big it is. And there's a limit too. On pure financial knowledge tests, one large study didn't find the pattern this way. But what's solidly proven on the stock market, you already saw. Too much confidence measurably costs returns. And one more thing, because the meme gets it wrong. Beginners are not more confident than skilled people. Confidence rises with skill, just much slower than skill itself. Science isn't a poster with a funny mountain. It's messier, and that's exactly what makes it more believable. So what actually helps? Not more confidence, and not less confidence either. Instead, measure, don't feel. Research knows 3 simple tools for this. First, the forecast journal. Before you make a money decision, write down one sentence. What do I expect? And why? 3 months later, you read it back. Your gut will tell you stories. Your notebook won't. Second, turn the question around. Before you decide, ask it out loud. Why might I be wrong? In studies, that one question alone makes your self-assessment measurably better. Arguing why you're right, by the way, doesn't help. Third, the good news from the original study. Learning works twice over. When the weakest participants got a little training, they didn't just get better. They saw for the first time how much they'd been missing. That feeling isn't a step back. It's the moment the bubble finally deflates a little and you start getting better. So, what do you take away? The famous curve is a meme. The thinking error behind it is real. After the first wins, confidence balloons, whether it's stocks, funds, or crypto, and it stays permanently ahead of skill. The tool against it fits in one sentence. If a few good trades make you feel like an expert, measure, don't feel. Write down your forecast. Turn the question around. Look at your hit rate. Your portfolio doesn't need a hero. It needs someone who knows their hit rate. Now it's your turn. When did you last overestimate yourself with money? And what did it cost you? Drop it in the comments. I read every single one, and the most honest story I'll pin to the top. If you want to know which other thinking errors quietly steer your money, subscribe to the channel. In the next video, we look at why your brain sorts money into separate pots and why that exact habit costs you. Thanks for sticking with me this far. See you in the next video. This video is education, not financial advice. Make money decisions yourself or with a qualified professional.